The idea of social insurance began in Europe in the 19th century. At its core, social insurance protects people against job-related risks, disability, death, unemployment, and so forth. The goal of social insurance is to improve not just the lives of individual participants in social insurance plans, but society as a whole. Let's take a look at Social Security. The Social Security Act was one of the first social insurance programs implemented in the United States. President Roosevelt signed it into law in the United States in 1935, and it went into effect in 1937. The act created the Old Age and Survivors Insurance OASI program, which later became the Old Age, Survivors, and Disability Insurance Program OASDI. Its purpose was to provide retired workers with a continuous stream of income after their retirement. Later, other provisions would be added to cover dependents and survivors of covered workers, as well as disabled workers and their dependents, and to provide health insurance coverage for the elderly. The Social Security Act was passed in the United States in part because workers were becoming less likely to have extended families to care for them in their later years, and more people moved from family farms to the city to work in industry. In 2016, the Social Security tax rate, which funds Social Security, was 12.4% of an employee's salary, shared equally between the employee and the employer on earnings up to $118,500. This tax is the OASDI portion of the Federal Insurance Contribution Act FICA tax that is withheld from an employee's paycheck. Most people have to work for at least 10 years to receive full credit, which accrues at the rate of about 4 credits per year depending on a person's earnings. The amount of Social Security income retirees receive is a percentage of their average lifetime earnings. However, lower income workers actually receive a higher percentage than upper income workers. Keep in mind that Social Security was meant to supplement an individual's retirement or disability income, not fully replace it. Medicare is the health insurance portion of Social Security for retirees age 65 or older and disabled workers. It's the second part of the FICA tax and became law in 1965. Your Social Security credits count towards Medicare eligibility. Employers and employees contribute equally to Medicare taxes. The tax rate for Medicare in 2016 was 1.45% of a worker's total earnings. The total FICA tax rate for employees for Social Security and Medicare combined was 15.3%, paid equally by the employee and the employer. The Federal State Unemployment Insurance UI program, created by the Social Security Act of 1935, provides temporary financial assistance to eligible workers who lose their jobs through no fault of their own. Almost all workers are covered by the program, although eligibility requirements are established by state laws. Railroad workers, veterans who've recently served, and civilian federal employees are covered by other similar programs. Because UI is a partnership between the states and the federal government, states must meet the federal guidelines developed for the UI program. In all but 3 states, funding for these benefits are based on an unemployment tax that employers are required to pay. Employers must pay a minimum amount of federal unemployment tax if they have 1 or more employees in each of at least 20 calendar weeks, or have 1 or more employees paid $1,500 or more in wages in any calendar quarter. The tax rate for each employer is determined by the individual state and is based on the number of unemployment claims filed against the employer. Public employment offices or other approved agencies pay out the compensation to unemployed workers who are required to demonstrate that they're actively seeking reemployment. When the unemployment in the United States is high, the federal government sometimes increases the number of weeks from the standard maximum 26 weeks. As an example, In the recent past, Congress passed an emergency benefit program that extended unemployment benefits up to 73 weeks, with the actual length varying from state to state. Funding for an extended time period is shared between the states and the federal government. Workers' compensation is a social insurance program that provides cash benefits and medical care to workers when they suffer injuries or illnesses related to their employment. In 1911, the state of Wisconsin established the first workers' compensation program that was not declared unconstitutional. All 50 states, as well as the District of Columbia, Puerto Rico, and the Virgin Islands, have some type of workers' compensation programs, though Texas and Oklahoma permit employers to opt out of workers' compensation insurance programs. Typically, workers' compensation provides cash benefits and medical care to employees when they suffer injuries or illnesses related to their employment. It also provides survivor benefits to dependents of workers who die due to work-related incidents. Workers who receive these benefits are not permitted to sue their employers for damages of any type. The federal government has its own program and also administers the Longshore and Harbor Workers' Compensation Act, which covers all longshore and harbor workers in the United States. The federal government has no involvement in the administration or financing of workers' compensation programs, nor does it have reporting requirements or standards for determining what constitutes a tax-qualified plan. Thus, information about actual costs of workers' compensation and the number of workers covered under the various states and U.S. territory plans is not readily available. Workers' compensation begins paying for an employee's medical care immediately after a workplace injury occurs. After a waiting period of 3 to 7 days, it pays temporary disability benefits, and it pays permanent partial and permanent total disabilities to workers with permanent disabilities caused by their work. Other costs covered include rehabilitation and training for employees who cannot return to their pre-injury jobs, and benefits to survivors of employees whose work-related injuries lead to death. Employer costs for workers' compensation include insurance premiums and deductibles that have to be met. If an employer is self-insured, meaning the employer funds the workers' compensation plan rather than buying insurance from a provider, the costs of the plan equal the administrative costs related to it plus any benefits paid out to employees. Employers can reduce their share of these costs by focusing on strategies such as educating employees about wellness and safety, ensuring that the workplace is free from hazards that could lead to injuries or illnesses, establishing return-to-work programs to get employees back to the job faster, and doing a better job of tracking claims to identify where health and safety problems are in their organization. Some of the main features of the law included ending pre-existing exclusions, requiring employer health plans to cover young adults up to age 26 on their parents' plans, ending lifetime limits on coverage for all new health insurance plans, limiting administration costs by insurance companies, and providing certain types of preventative care at no cost. Different parts of the plans were scheduled to start at different times. Employers with 50 full-time employees or a combination of full-time and part-time employees equal to 50 full-time employees during the previous calendar year are required to be in compliance under the Affordable Care Act's Employer Shared Responsibility provisions of Section 49080H of the IRS Internal Revenue Code. Employer shared responsibility provisions requirement under the Affordable Care Act for employers with equivalent full-time 50 employees or more to offer affordable health care coverage to their full-time employees and their dependents, or be subject to an employer shared responsibility payment under certain conditions. For purposes of the Affordable Care Act, a full-time employee is someone who works on average of 30 or more hours per week. Employers who meet the requirements to comply with the Act are known as applicable large employers. Under these provisions, employers will need to offer affordable health coverage to their full-time employees and their dependents, or they may be subject to an employer shared responsibility payment. The health coverage offered by the employer must provide a minimum level of coverage. It must be offered to 95% of employees if the employer has 100 or more full-time employees, and offered to 70% of employees if the employer has 50 to 99 employees. The coverage is considered affordable as long as the employee's share of the cost of the coverage is less than 9.5% the employee's annual household income. Employers may be subject to the payment if at least one full-time employee is receiving a premium tax credit because he is purchasing individual coverage in affordable insurance exchange, otherwise known as a health insurance marketplace. These provisions apply to for-profit, nonprofit, and government employers. There's some good news, however. The cost of family premiums slowed from an average of 11% annual increase to an average of 5%. The cost of family plans, employer and employee parts, ranged from below $10,000 annually to over $24,000 annually. Healthcare costs have increased for a variety of reasons. Individuals are living longer and working longer. Whether we like it or not, there's often a correlation between one's age and the need for healthcare, and newer medical technologies, as well as drugs for treating everything from headaches to cancer, are often costly. Companies employ a number of different approaches to maintain healthcare costs. These approaches include traditional plans, managed care, high-deductible healthcare programs, generic and mail-order drugs, and wellness programs. Traditional plans include those available through insurance carriers, community-based plans such as Blue Cross, Blue Shield, and employer self-insurance. Under these traditional, fee-for-service plans, an employee typically has to meet a deductible before the insurance plan pays for most medical services, and even then, the plans sometimes pay only 80% or less. Employees can choose the doctors they want and usually don't have to live in a certain geographic area to participate. These plans generally do not pay for preventative care and pay only part of the costs of diagnostic tests. Managed care plans are the oldest of the approaches to healthcare cost management and include health maintenance organizations, preferred provider organizations, and point-of-service plans. Major differences in the three types of plans include how payments are made and the way medical costs are determined. These plans provide health care to members for a set monthly fee for a comprehensive set of services. Primary care physicians serve as gatekeepers. Health maintenance organizations known as HMO, the first type of managed care programs, originated in 1973 when the Health Maintenance Organization Act became law and allowed third-party payers to participate in healthcare payments. Third-party payers are companies, insurers, and other entities that negotiate healthcare options for employees rather than the employees doing so directly. HMOs became very popular in the 1980s. They often require that an employee live within a designated service area and use doctors and facilities that are specified by the HMO. The plan pays for medical services if the healthcare providers are designated in the plan. Each employee identifies a primary care physician and then goes to that person, who can then refer the employee to a specialist within the HMO if needed. A second approach to managed care is the use of preferred provider organizations, or PPOs. In a PPO, an employer negotiates with healthcare providers, usually in a network, for discounts. The providers must follow strict standards about the number of diagnostic tests they order and must adhere to cost controls. The employer also gives its employees an incentive to use preferred providers. When they do, the rates they pay are lower. Thus, employers save money on their healthcare costs, employees have a greater choice of doctors than they do with an HMO, and doctors are assured a flow of patients. If employees use a doctor not in the PPO network, they pay a higher copay. A copay is a minimum amount an employee must pay for healthcare, including a doctor's visit, a prescription, or a diagnostic test. The third type of plan is a point-of-service plan. This plan can be best described as a hybrid between an HMO and a PPO. In a POS, the employee can decide which plan to use as needed. The employee might choose to use the HMO component to see a primary care physician, but receive treatment following a referral through an in-network physician in the PPO. Individuals can also receive treatment outside the network, but must pay a deductible of $500 or more. The HMO and POS options tend to have lower premiums, cost to belong to the plan, than PPOs because they require that the primary care physician decide whether an employee should be referred to a specialist. They also have lower premium increases than PPOs as a result of this requirement, although in the past couple of years that's been changing. There are, however, a number of criticisms that have been raised regarding HMOs and POSs. One concern is that physicians act as gatekeepers to the care of patients. Due to the way that physician payments are structured, the plans can give physicians an incentive to limit their patients' access to specialists and certain diagnostic procedures. In fact, as a result of consumer and government pressures, HMOs and POSs have been approving more patient referrals in recent years, even though the practice drives up costs. Another criticism of HMOs and POSs is that the plans limit how much the employee has to pay out of pocket for costs. Consequently, employees may not be as careful about taking care of their health as they would be if they had to pay more of their health care costs themselves. Employers have adopted a variety of alternative approaches to address the concerns about healthcare plans. These alternatives come under the rubric of consumer-driven health plans, or CDHPs. CDHPs put more of the decision-making control in the hands of employees. The main idea behind a CDHP is that giving employees more responsibility for their healthcare costs will cause them to pay more attention to their health and healthcare-related treatments and plans. These plans are popular with employers. In the past several years, more employers have turned to high-deductible health plans, HDHPs, as a way to manage the costs of employee healthcare plans. HDHPs are also referred to as catastrophic health plans because they don't pay for the first few $1,000s of a person's medical costs each year. Thus, they pay only when the employee has a major medical problem. Because of their high deductibles, these plans are less costly for employers, and employees' monthly premiums are lower too. Employees in an HDHP can also participate in health savings accounts. Health savings accounts, known as HSAs, were created as part of the Medicare Prescription Drug Improvement and Modernization Act of 2003. HSAs are an example of an account-based health plan, an ABHP, a consumer-driven plan that pairs a group health plan with a tax-advantaged medical spending account. HSAs provide a way for employees to pay for their immediate healthcare expenses not covered by a high-deductible health plan, an HDHP, and save money on a tax-free basis. The basic idea behind an HDHP is that you can save money on the cost of the high-deductible health plan. Compared to having healthcare plans with lower deductibles, you can put aside the difference to cover the medical costs you incur. A health reimbursement account, known as an HRA, is another form of ABHP and is another mechanism for paying the healthcare costs of employees. There are several differences between HSAs and HRAs, even though the purpose of both is to reimburse employees for qualified medical expenses. As an employer, an employee, or an employee's family member can put money into an HSA. In contrast, only the employer sets aside money in an HRA. Employers can deduct the cost of HRAs on their taxes, and in the same way, they can deduct the cost of health insurance they provide to their employees. When the employee leaves the company, whether that's for retirement or other reasons, funds left in the account are accessible to the employee. However, the accounts are not portable. They remain with the employer that provided them, and they cannot be used for retirement income. In an HSA, the funds belong to the employee, and they can be rolled over to the next plan year and withdrawn for retirement, subject to a penalty if the withdrawal occurs before age 65. Only with a few exceptions, employees who have an HRA cannot have an HSA. Instead of contracting with an insurer such as Blue Cross or Blue Shield or Sigma to design and deliver all or part of their benefits programs, companies can decide to self-fund their programs or self-insure. Many large employers and a growing number of medium and small employers make this decision each year. By self-funding, employers avoid having to pay premiums and taxes on those premiums, and they avoid some of the state requirements for benefits. These programs, known as wellness programs, are typically categorized as lifestyle programs, such as memberships in fitness clubs or disease management, including prevention and management of chronic illnesses. The disease management programs provide the most short-term return on investment known as ROI, but lifestyle management programs affect employees' overall well-being, and that's important in the long term. The purpose of these programs is to reduce health insurance costs by encouraging employees to become educated about their own health and to participate in programs to improve their health in general as well as their health on the job. Wellness programs typically include the following: a health risk assessment to identify employees at risk for chronic diseases, the identification of programs and incentives to motivate employees, education and awareness programs to promote the wellness efforts that encourage employees to take responsibility for their own health, and an evaluation of the program's outcomes. Because wellness programs make employees more aware of health and safety risks and educate them about how to stay healthier, companies that use these programs expect to realize sustainability and lower healthcare insurance costs. Unfortunately, the employees who usually participate are the ones who already are a firm's healthier employees. Thus, companies have found that just having a wellness program is not enough to change behavior of employees. Instead, firms are using incentives to encourage their employees to participate in their wellness programs. One criticism of wellness programs is that they don't typically take into consideration the design and furnishing of an employer's workspace. Health hazards, such as poorly ventilated heating and cooling systems and non-ergonomically designed work setups, can create health problems for employees. However, safety programs often do address these issues. Another criticism relates to concerns of discrimination and privacy when employees are required to participate in health assessments. Only legally permissible information should be shared with employers. An employer who uses information from a health screening in a way that labels a person as disabled and negatively impacts his job opportunities may be violating the ADA. To help employees cope with these mental health issues, substance abuse issues, and life challenges, companies offer EAPs, known as Employee Assistance Programs. Employee Assistance Programs, EAPs, are a resource for employees dealing with personal problems, including services such as attorney consultation, child care and elder care options, budget information, addiction recovery, and family counseling. EAPs were started in the 1970s primarily to provide a resource for managers dealing with employees who had or appeared to have substance abuse problems. Today, an employee can use an EAP to consult with an attorney, find out about child or elder care options, get information on budgeting, and seek family counseling. Managers who suspect that an employee has a substance abuse or other personal problem can refer that employee to the company's EAP. These plans pay a percentage of the employee's salary during the time the employee is out of work due to a disability. A short-term disability plan is an insurance plan that pays a specified portion of an employee's salary when the employee is out of work for a limited time due to a disability. Long-term disability, or LTD insurance, typically starts after a specified period of time, usually 6 to 12 weeks as an example, from the time of a disability and pays a portion of the employee's salary until retirement age. The cost of disability claims in 2013 was $9.8 million. Even though the number of employers offering long-term disability plans for employees was up to more than 214,000 in 2013, fewer employees are electing this voluntary benefit. Many employers are instituting return-to-work programs to get employees back on the job as soon as possible. These programs typically specify when an employee is eligible to return to work and under what conditions. These programs are important to the employer for productivity reasons and are important to employees as well. Work provides a sense of order and purpose for most people. Before rolling out a return-to-work program, however, employers need to carefully think how legal requirements, such as those of the ADA, FMLA, Pregnancy Discrimination Act, Workers' Compensation, and the FLSA, will affect the program. Employers considering such programs need to have a good understanding of the cost of having employees out on leave, have an organizational philosophy and policies about how leave should be managed, and ensure that employees are not put in a position to have to return to work too early. Accidental death and dismemberment insurance, known as AD&D, is designed to compensate employees for the loss of a body part or to compensate the employee's family if the employee suffers the loss of a limb or dies accidentally at work. AD&D insurance pays you and your beneficiaries a set amount of money if your death or dismemberment is the direct result of an accident. However, there are coverage restrictions that make accidental death and dismemberment insurance far less useful. The insurance usually specifies how much will be paid for the loss of each body part or for an accidental death, and it's likely to be more valued by workers in manufacturing and skilled trade jobs than by white-collar workers. The term life management benefits more accurately reflects the idea that work is part of life rather than separate from it. Designed to help employees achieve a balance between their home and work responsibilities, these benefits include paid time off, child care and elder care assistance, financial planning, and concierge services. Many of the life management benefits that organizations offer today were instituted in an attempt to retain women in the workforce. When employees are able to get away from the workplace for rest and renewal, they're more productive when they return. Also, employees need to know that when they're sick, they can and should stay at home. To accommodate the needs of employees for time away from the job, employers provide paid time off in the form of vacation, sick leave, bereavement leave, personal leave, and holidays. Paid leave was the most frequently provided employee benefit in 2012, with 84% of private industry workers having the opportunity for personal, holiday, or vacation leave. Instead of breaking down leave into all of these categories, some employers give employees a certain number of days per year to take as paid time off, known as PTO. PTO leave can be specified for a number of days per year or accrued on a monthly basis, based on the length of time the person has been employed. Many employees observe different religious holidays. PTO gives them the flexibility to take off the religious holidays of their choice rather than holidays designated by the firm. Employers offering tuition assistance believe that when their employees acquire more education, they bring more human capital to the workplace and are, therefore, more valuable on the job. Some employers will reimburse their employees only if they make certain grades in their courses. Some employers require their employees to agree that they will remain with the company for a set period of time after completing their education. Baby boomers, people born between 1946 and 1964, are most likely to feel the effects of child care and elder care responsibilities. Hence, this group is sometimes referred to as the sandwich generation. A study by the National Alliance for Caregiving and the AARP in 2015 found that 6 in 10 family member caregivers were employed at some point over the year prior to the study, with 56% of caregivers working full-time. The majority of these caregivers had to make changes in their work schedules to accommodate caregiving responsibilities. Long-term care insurance, known as LTCI, provides assistance to aging, disabled, and ill persons who need daily help with tasks such as dressing, eating, or bathing for an extended period of time. Often, employers offer LTCI to the extended family members of their employees, including their parents and in-laws. Generally, employees pay for the premiums for these insurances themselves. Making this benefit available to your employees can give them a peace of mind. When they're at work, they know that their loved ones are being cared for. If employers pay some or all of the cost of LTCI, the cost is fully tax deductible. The LTCI benefits that employees receive are also tax-free. Life insurance provides financial protection or income for an employee's family in the event of the employee's death. Thus, life insurance has been described as a basic pillar for retirement savings because it provides psychological comfort. Employer plans are often limited to $50,000 of coverage, although some employers offer an amount equal to 1.5 times the employee's annual salary or more, or allow the employee to purchase greater coverage than the employer provides. A lot of plans allow employees to buy insurance to cover their spouse and/or children at a group rate cost as well. Financial planning services increase the financial literacy of employees and can help them achieve financial security. Legal services can be offered as voluntary benefits for employees as well. A life management program is an intervention designed to promote lifestyles and behavior change and is widely used in the field of health promotion. The Employee Retirement Income and Security Act, known as ERISA, is a federal law that protects retirees in the private sector. Just a few of the benefit plans covered under ERISA are pension, health, disability, life, and accidental death and dismemberment, and cafeteria plans. Under ERISA, private employers must have written plans documenting the pension benefits they would provide to their employees. These plans must specify what the benefits are, who is eligible to receive them, as well as when and how the plans can be terminated by employers. ERISA's major function is to ensure that firms treat their employees fairly with respect to their retirement accounts. We now describe some of the major provisions of ERISA. Vesting refers to the time required before you own part or all of your retirement funds. The money you pay into your retirement plans plus earned interest on that money is 100% vested immediately. This means that you have a non-formidable right to these funds even if you leave your employer before you reach retirement age. Your employer can require you to fulfill certain service requirements before you are vested in the money it contributes into your retirement. ERISA provides minimum standards for vesting. Your employer can use a different standard as long as the ERISA minimum is met. There are two ways in which employees become vested: cliff vesting and graded vesting. Let's take a look at these vesting methods. Under cliff vesting, employees become fully vested when they have 3 years of service. This means that employees own the employer's contributions of their retirement funds after 3 years of working for the employer. An employer has the right to allow the employee to be fully vested before 3 years of service, but cannot require a longer vesting time if it uses cliff vesting. The other option, graded vesting, is a phase-in plan. Under such a plan, an employee must be fully vested, that is, entitled to their firm contributions, within 6 years. After the second year of service, the employee must be vested at 20% of the employer's contribution, with the percentage increasing 20% each year thereafter until 100% vesting is reached at the end of 6 years of service. Some employers make retirement plans available to their employees but require them to fund their own accounts. However, most employers that offer plans such as these either make the entire contribution, providing some matching funds, or some combination of the two. A non-contributory retirement plan is one in which the employer puts funds into an employee's account without requiring the employee to make contributions. A contributory retirement plan is one in which the employer and employee both put money into the retirement account. An employer can have both types of plans, non-contributory and contributory. A defined benefit pension plan is a plan that provides an annuity to eligible employees upon retirement with the amount paid per year based on a formula that usually includes a company-determined percentage, the number of years worked, and either the last salary or some average of previous year's salaries. The annuity is either a specified dollar amount each month or is based on a formula that usually involves multiplying the number of years an employee worked at the company by a designated percentage by the last or highest salary. The salary amount can also be an average of the number of years of salaries. For example, the average of the person's salary for the last 3 years he or she worked for the firm. Under this type of pension plan, the employee is promised an annuity that increases the longer the person has been with the company. The economy can play a major role in the success of these plans. Low, long-term interest rates, a stock market that isn't climbing rapidly, extensive regulations, and global competition from firms that don't provide retirement programs such as these create a huge financial burden on firms that are trying to manage defined benefit plans. In the past 5 years, a large number of companies have turned their pension programs over to the Pension Benefit Guarantee Corporation, known as the PBGC, a not-for-profit organization created by the federal government that insures defined benefit plans. Employees who receive their pensions under the auspices of the PBGC, because the pensions of their firms are either underfunded or insolvent, are limited to a maximum amount per year. For many years, the predominant type of retirement plans for older, established firms in the United States was the defined benefit plan. This is no longer the case. In 2013, only about 2% of U.S. workers were covered by this type of plan. Another 11% were covered by a defined benefit plan and a defined contribution plan. Such plans are still widely available for government employees. Many companies have frozen, terminated, or closed access to defined benefit plans for new hires and instead offered them a defined contribution plan. In 2004, for instance, 96 Fortune 1000 companies had at least one plan that was not available to new hires for those reasons. By 2006, that number had jumped to 162 and continues to increase. Defined contribution plans are a plan which the employer specifies where money will be deposited and often gives the employee the power to decide how much money will be invested, with the retirement income being a function of how well the money put into the plan was invested. Under a defined contribution plan, the amount of retirement income is a function of how well the money put into the plan is invested. The employer specifies where the money is to be deposited, sometimes providing several options of places, and often gives employees the power to decide how that money is invested within a place. A 401k plan, named after the section of the IRS code that permits these types of plans, allows employees to defer receiving some of their compensation until retirement. The money contributed by the employee is taken out of the person's payroll check, pre-tax, and it accumulates tax-free until the person retires. Only when a person begins withdrawing the funds upon retirement is it taxed. There is a dollar limit on how much can be deferred each year, however. In 2016, the limit was $18,000 for traditional 401k plans. And the IRS has a provision that permits employers to include an elective deferral provision for individuals over the age of 50 to make catch-up contributions. A cash balance plan is a type of defined benefit plan that operates like a defined contribution plan because it defines the benefit a person receives upon retirement in terms of a cash payout. What does that mean? The employer credits the participant's account with a pay credit and an interest credit. The pay credit might be a percentage, for instance, 5% of the employee's compensation, whereas the interest credit can either be a fixed or variable rate tied to an index. When it was passed in 2006, the Pension Protection Act, referred to as the PPA, was often called historic and groundbreaking. The legislation resulted in a large part from an increase in the number of firms that were turning their pension plans over to the U.S. Pension Benefits Guarantee Corporation because they could not afford to pay the pensions. The act was designed to strengthen the U.S. pension system. In essence, the PPA tightened rules relative to employer responsibilities for funding pension accounts and for administering and terminating pension funds. The Act requires employers to pay more attention to how they're managing these funds, particularly if they have an underfunded pension plan. It also raises caps so that employers can set aside more money when the economy is doing well to offset the fact that less money goes in during other times. Workers often don't know how much money their employers are spending on their benefits. To address this issue, an employer often provides a detailed listing of how much each benefit or service is costing the organization in addition to the employee's basic salary. This information helps the employee understand more about their total rewards from the organization. When considering changing jobs, employees can use this information to compare their total rewards package with what another employer might be offering. Employers have to make decisions about which employees will receive which benefits, how much the employer will pay versus how much the employee will contribute, and how much choice the employee should be given. Age, marital status, number of children, and other demographics of an employee affect the person's preferences for different benefits. To assist their employees with different types of needs, employers have developed a number of flexible benefit plans. Flexible benefit plans, also known as cafeteria plans, allow employees to choose which benefits they want to purchase from a menu of benefits. Some companies require all employees to receive certain benefits, usually health insurance, but can allow them to choose which others they want to purchase.